Welcome to webinar 6 of the 12-part Value Gap series. Today's topic is the accidental family office, building your collaborative financial team. Before we begin, though, I want you to consider this. Most business owners with a $2 million or more EBITDA have already solved the wrong problem. They've hired great advisors, they've paid real money, and they've checked the box. And then they walk away thinking that the job was done. Unfortunately, it was not. The job of hiring good advisors and the task of building a team that functions as one are two completely different jobs. Today's about the latter, and we're going to talk about building a team that functions as one.
Look, so if you're watching this, you're likely a business owner running a successful business, or you're a professional that works with business owners that are running a business. And I want you to realize that in building a business, especially one that's large enough that now you need assistance, right? You're not large enough to actually hire the people like a C-suite full time, but you need that experience when needed to get you to that next level. So this way you'll have real advisors in your financial life. It feels complicated and it shouldn't. And so that's what we're going to talk about today. We're going to show you why that feeling is not a coincidence. And we're going to give you the framework for really fixing it. And so I want to be upfront, as we always are, when we start these webinars. We have two goals today, as we do with every one of them. We want to teach you something that is generally useful about how your advisory team should be structured. And then the second is that if we share today, what we share with you today that resonates with you, like we're going to ask you to take, just a little bit of time, schedule a complimentary value gap assessment call with us. Right? This is like a no cost, no obligation phone call, but it is the deal, right? We want to provide value for you guys, or the professionals providing value for their clients, to get a better understanding of how a coordinated team actually helps the business owner and the professional create that additional value.
And before we go any further, let me get the obligatory compliance hoopla out of the way. As always, everything we cover today is educational in nature. It is not specific for specific financial, tax, or legal advice. Your situation obviously has details that are unique to you and your business, and anything we discuss here today should be reviewed with your qualified advisory team before you act on it. In addition, we are not going to tell you that your current advisors are wrong. What we are going to show you today is a different way to think about how those advisors connect and communicate, and how they can best work for you.
So John mentioned this is part 6 of the Value Gap webinar series. Each session in the series is built for business owners that are making significant revenue, 2 or more million in their business, who are thinking about, or who should be thinking about, and by the way, that's a caveat because all of you should be thinking about this, exiting the business in 1 to 5 years. And so if that is you, stay with us. And it is you, because like I said, every one of you, business owner, professional, will be exiting your business voluntarily or involuntarily at one point or another. So before we teach you anything, before we get into this, I want to name, and we like to name some of the myths that go around some of these topics before we jump into them, because we know that every client, when they sit down with a professional, has their preconceived notions, their judgments about how this conversation is going to go. And things that we hear all the time, like the first one being, I already have a good team. They don't need to talk every week, or they don't need to meet all the time. And I get that. And we're not saying they need to be on the phone constantly. What we're saying is there is a difference between advisors who are aware of each other and advisors who actively coordinate with each other. And most teams are the first. Very few are the second, and that's where the gaps in the communication and gaps in the planning happen, is between those conversations. As a matter of fact, John and I did a whole webinar on this. You can find it on our LinkedIn. You can find it on the YouTube channel. The second is that my CPA and attorney have worked together before. I think we're fine. And you know what they say about I'm fine, right? It's the biggest lie that we tell ourselves. But working together on one transaction or having one conversation about one aspect of your business is not the same as a standing system of communication. One deal does not build an architecture. The third, adding coordination sounds like adding cost. In our experience, the cost of coordination is significantly lower than the cost of the gaps it closes, especially when we're talking about an exit value. And if you're in certain industries, you're looking at a 6 or 7x multiple on that EBITDA. And if you don't have a coordinated team, that could be worth hundreds of thousands, if not millions of dollars. So there's a lot on the line when we talk about having a coordinated team. So the fourth, I do not want one person controlling all of my advisors. And honestly, John mentioned this, neither do we. Like, we're not here to tell you to get rid of your advisors and just have one. The goal of what we're going to share today is not to replace anyone on your team or to put one advisor in charge of the others or everything that you want to communicate. This is about building a system where they are aware of and responsive to each other. They're all playing from the same playbook. And so you maintain control. You maintain decision-making. It's just now everybody's operating from the same playbook. The fifth, which I've already addressed a little bit, this is probably a sales pitch. And it's not. Told you up front, the pitch comes at the end, and the pitch is nothing more than a value gap assessment. Everything between now and then is just real content, hopefully that you can take to your professionals now, start asking better questions. If it is not useful for you in this moment, the only thing we ask for you to do is share it. That's it. There is no pitch. There's no sales pitch. There's no obligation to this. Okay? So before we jump into this, as always, we think it's important for you to know who we are. My name is Mike Clark. I've raised $42 million for businesses across multiple industries, got my MBA in 2015. And across every one of those companies that I work with, I started noticing the same thing. And that was that advisors who are supposed to be helping these business owners structure their capital raises or entity structures, they weren't talking with each other. There was not a lot of strategy to it. It was inconsistent, and everybody pointed fingers at that's not my job, it's theirs. Or don't talk to me until this happens. And that left a lot of confusion when you're trying to raise money and run a business. So this isn't about, advisors being bad, because they weren't. None of the advisors, they're all professionals. They're all great in their lane. It was that nobody had built the systems connecting them. And every one of them was doing their job at a great level. And the business owner was the one trying to put the pieces together to get more clarity. So in that observation, and that's one of the reasons why we built the National Referral Network, and it's why we believe, and actually I believe to my core, that building wealth is a team sport. And so I feel that my job as a wealth manager is not just to manage money or manage investment strategies, but to help you manage the team to get more clarity.
And my name is John Heck. I've spent several decades in financial services, mostly working with business owners at various stages of personal and business growth and exit planning. And the pattern that Mike is describing here is one that I've seen as well. So you've got oftentimes very smart people running businesses with very smart, experienced advisors with real credentials on both sides of the coin. Yet there tends to be a gap between those professionals that nobody was responsible for closing. So one of my responsibilities in the work that we do is to take the concepts that we talk about every day and translate them into a process. And when we talk about building a coordinated financial team, I'm often the one who maps out what that coordination actually looks like step by step. What gets communicated, how often, and who's accountable for making sure that it happens.
Okay, so I put this in here because I ask clients this quite often. And here's something I want you to sit with kind of before we move on for a second. If you are the one bringing strategies, ideas, concepts to your advisory team, rather than them bringing strategies to you, you may want to consider whether you have the right team. And I know that we mentioned that we're not here to replace your team, and we're not. But at the end of the day, this is your business, this is your exit plan, and nobody's going to be there at the end to compensate you if things go sideways right now. And you won't know that they go sideways until later. So if you're bringing tax strategies because you're hearing things on the internet, which is fine, do your research. But if your CPA is not bringing strategies to you on a regular basis, or your attorney is not calling to check in on you about your entity structure, what's going on in the business, you might want to start asking better questions, right? And this is what we're trying to convey here, is that it's not bad for you to challenge the professionals. You should benchmark all of them. I tell my clients all the time, challenge me every year, benchmark me. Go look at other advisors. Tell me what they're doing, what they're not doing, so I can get better. And so think about that for a second. Are your advisors bringing things to you that are going to better your business in the next 90 days? And if not, ask them why. Okay. Think I hit that one hard enough? Yeah, John?
I think so.
Okay. So here is the assumption most business owners carry. And this assumption costs them the most, right? The assumption is this: if my advisors are good enough, my financial life is covered. And that assumption is wrong. I mean, quite honestly. And not because your advisors are not good. They probably are. It is wrong because advisor quality and advisory architecture are two completely different things. And most business owners only have ever thought about one of them.
And here's what Mike means by architecture. When we talk about advisory architecture, we're talking about the system that connects your advisors to each other, not the advisors themselves necessarily. The system, the advisors understand that we're talking about the system. The advisors are part of the system. So think about it this way. You can have 4 world-class surgeons in a hospital, but if they have no communication protocol, no shared patient chart, no coordinated treatment plan, the patient's still at a great deal of risk. The individual excellence of each of those surgeons does not always solve the systemic gap that the patient needs. And that's the situation most business owners with $2 million or more in EBITDA are operating in right now. World-class advisors and no shared chart.
All right, so here's the part that that makes sense, or that makes it a wealth problem, right? Because it's not just an organizational problem. Your tax situation affects your deal structure at exit, okay? Your deal structure affects your estate plan, or how you structure an estate plan. Your estate plan affects how you invest. So, right, these things are connected at every level. And when the people responsible for each one are working independently, the gaps between them become the problem. The gaps between them are where the dollars start to slip out, right? Where you start to leak money and you're not being optimized. And so that is your problem. And I don't mean to put that on you, but this is where you need to start challenging the professionals that you work with to get better results and better answers. And this is why, we built the National Referral Network, because it's designed to deliver what we like to call a collaborative wealth architecture. And it's the framework that we're going to walk through today. It is a team of professionals that you can call on when needed, that all play nice in the sandbox, that understand the importance of collaboration with other professionals, right? And this is not a product. It is not a fund. It is not something you buy. It is a system for connecting your existing advisors into a team that functions with intention rather than consequence. It's about being proactive versus reactive. So before we go any farther, want to ask you something real quick. Goes back to the first part of this thing, because if we show you today, what we show you today makes sense, then what we're asking again, and I want to be clear with this, we're asking for you to take the time to schedule the value gap assessment. That is all we're asking for. This is, once again, it's not a pitch, it's not a commitment. I want you to go into this open-minded, not judging the information, but just listening to it. And how are you interacting with your professionals today to optimize your growth in your business? Awesome. So we want to show you two professionals. These are not case studies. They are descriptions of two types of business owners that we meet. And as we go through these, you'll know which one you are, hopefully in a roundabout way.
So profile one is what we call the collector, and the collector has done everything right on paper. They have a good CPA, they have a good attorney, they have a good wealth manager, and probably a very good banker and maybe an insurance advisor or two. All of them have the proper credentials, and all of them are very well experienced. But there is, but here is what is also true about the collector. Each of those professional advisors that I mentioned was hired independently, and each of them sends their own invoices. Each of them has their own relationship with the business owner, and almost none of them have any standing relationship with each other.
And look, it's not, and we've said this before, right? It's not that the advisors are giving bad advice. In most cases, they're not. The problem is that the advice given in isolation tends to optimize for the lane it came from, okay? So the CPA optimizes for tax efficiency, which is a little bit of a stretch because most CPAs just do tax prep and file. They're happy historians. No offense to CPAs, but that's just the reality. The attorney optimizes for the legal protection. The wealth manager optimizes for the portfolio, if you even have a wealth manager. But none of these are wrong, right? We're not saying that. But none of them are accountable for the full picture, and none of them are accountable to each other in terms of making decisions.
So think about the junk drawer for a second in your house. Let's say you've not gone through it in years, and every time you open it, there's something in there that you can't identify. Maybe there's a note that you can't decipher, or something that might matter, but you have no idea what it goes to. So you just close the drawer and you move on. And that's what the collector's financial life typically looks like. The pieces are all there, but nobody has gone through the drawer, and the business owner is the one who keeps opening it and hoping that nothing falls out of the drawer. Now, profile two is what we call the architect, and the architect has a similar team in terms of credentials. What is different for the architect, though, is that the system connecting his advisors. In the architect's world, the advisors are each aware of one another, and there's a standing communication protocol. So, for example, when the CPA identifies a strategic opportunity, the wealth manager knows about it. And when the attorney updates the entity structure, the tax implications have already been reviewed before any action is even taken. The advisors are not just doing their individual jobs in their individual lanes, but they're doing them in coordination with each other.
And this did not happen by accident.
No.
Like, somebody built that system.
Mm-hmm.
Somebody decided that coordination was not optional. It was one of the professionals, it was a business owner, it was somebody. Somebody took responsibility for making sure the advisors were not just excellent individually, but functional as a team. And that is what we do. That is what we're talking about. That is what the collaborative wealth architecture is, and is what today is all about. So the collaborative wealth architecture has three components, and we're going to introduce them one at a time. And then John's going to walk through, or we're going to walk through each one of them and how they kind of look in practice. So the first component is what we call the shared map. The shared map is a single unified picture of the business owner's financial life. Oftentimes it's a financial plan that every advisor on the team can see and contribute to. Not separate reports. They're not individual files. It's one map.
And the mechanics here are pretty straightforward, but unfortunately, most advisory teams skip this step entirely. The shared map includes the current entity structure, the tax position, the investment strategy, the estate plan, the exit timeline, and other things. But it's the key here is that it's all in one place and it's all visible to all the relevant advisors. So when the CPA makes a recommendation, they make it with the investment strategy visible to them. When the attorney updates the trust, for example, the tax implications are already part of that conversation. I want you to understand that the map does not make the decisions here. It simply makes sure that the decisions are made with full and complete relative information. That's incredibly important to understand here. Now, the second component is the communication protocol. This is the standing system that keeps the advisors connected on a regular basis. It's not just when something breaks. So in our experience, the difference between a coordinated team and a siloed team is not the quality of the advisors. And this is important to understand. It is the frequency and the structure of their communication. A coordinated team has a rhythm, very much like a football team can have a rhythm. We've all seen it, right? If you're a football fan, you've seen this over and over. When an offense has that rhythm, blocks are made when and where that they're supposed to be made. The quarterback and the receivers are in sync. It just seems like everything's falling into place. They're moving the ball down the field with precision. And when they're out of sync or they lose that rhythm, it's equally obvious. That's where you see the miscommunication, where the quarterback's throwing the ball and there's nobody within 5 or 10 yards of him. You're like, well, how did he do that? Why didn't he see that, right? Because they're out of sync. He thought the receiver should be there. So I think you get the point. So in business, what happens is quarterly reviews with your advisory team at a minimum is what you should be looking for. Your advisors should have immediate contact with each other when something material changes within the business. And you also want a clear point of contact who's responsible for making sure that nothing falls through the gaps.
And here's what that means in practice. It means that when your business hits a milestone, when your revenue crosses a threshold, whatever that may be, when your exit timeline shifts, your entire team knows. Not eventually, not when you remember to tell them. They know because the protocol makes it automatic. So the third component is the strategic quarterback. And John mentioned this a little bit ago, right? In the last section there. Every coordinated team needs a person who holds that big picture. They are responsible for making sure the map is current, the protocol is followed, and the advisors are actually talking to each other. And in the context of what John and I are talking about, that role sits with the wealth advisor, not because wealth management is more important than tax or legal, but because the wealth advisors tend to be the one focused on the long-term financial outcome of the business owner. They're the ones that typically design the financial plan. And so that long-term focus is what makes the coordination role more of a natural fit.
So it's important to note here too that the strategic quarterback that Mike's talking about does not override the other advisors. That's not the purpose here. They don't make legal decisions or tax decisions. What their job is primarily coordination, not authority. That's an important distinction. Think of them as the general contractor. They're not the electrician or the plumber, for example. So here's a scenario that illustrates what that profile one looks like in practice. Let's call this business owner Thomas. And let's say Thomas, I have to tell you here that Thomas is a composite. He's not a specific client. So any clients out there named Thomas, we're not talking about you. All right. Thomas runs a manufacturing business. Let's say $3.2 million in EBITDA. He has a CPA that has worked for 9 years with the business owner, an estate planning attorney that he engaged about 3 years ago, the wealth manager he brought on board about 2 years back. And all three of these individuals are experienced professionals, and all three have done a very good job for Thomas independently. But here's the difference. Thomas decided to explore a sale, and he engaged a mergers and acquisition advisor. It's pretty typical in that situation. That's what you want to do. But in the early stages of the process, a few things surfaced. He realized that his entity structure, which the attorney had designed for asset protection some years earlier, created an unexpected tax complexity in the proposed deal structure that was currently on the table. And the CPA had not been aware of the entity design because Thomas had handled those two relationships separately. The wealth manager had a portfolio allocation that assumed Thomas was not going to have a liquidity event for another 5 years.
Which is interesting. I apologize for the pause there. I'm just thinking, John, you and I spoke about this when we went through this presentation, is that I've got a client right now that has that problem. Mm-hmm. The attorney structured the business in a certain way and moved the assets into that entity, and now they're selling the business, and it's going to be a challenge to unwind, right? And in that scenario, in that profile, nothing is anyone's fault, right? The attorney did their job to the best of their ability. They did what they thought was right. The CPA did their job. In my particular situation with my client, they didn't have a wealth manager, but in yours, in this Thomas, the wealth manager did theirs. But because their jobs were done independently, Thomas spent several months and real dollars reconciling gaps that a coordinated team would have seen coming, right? Or at least started to have that conversation. And that is the cost of this collector profile. It does not always show up as a disaster. Sometimes it shows up just as friction. Sometimes it's time. Sometimes it's going back and having to do rework, like in this profile. But the bottom line is opportunities cost money, and they need to be closed before they're identified. Okay, so the second profile here, we're going to, same scenario, it's a composite, call her Sandra. Sandra runs a professional services firm, and right now a lot of those are being purchased by private equity. So this is very appropriate right now. She had roughly 2.8 million in EBITDA, and when Sandra came to us, she had a good team in place. Obviously, a CPA, attorney, wealth manager, financial planner, all of them professionals, all of them very solid. What she did not have was any structure connecting them. So the first thing we did, obviously, we built a shared map. We built a financial plan for Sandra. We pulled together her entity structure, tax position, investment allocations, estate plan, and the exit timeline with all the professionals that need to be a part of that conversation. And we put them in one document that all of them could see. And it took, a couple weeks to do this because it's coordination. But the idea is we got everybody together, and it was done. Two things became immediately visible.
So what the map revealed was that Sandra's estate plan had not been updated since her EBITDA crossed $2 million, and the structure had been designed for a $1.5 million business, was not optimized for the business that Sandra was now running. And that was not an error by the attorney, as we said earlier. It was a communication gap. Nobody had flagged that because the business had changed in a way that warranted a review. And the second thing that the map revealed was an alignment issue between her investment timeline and her exit timeline. Her wealth manager structured her portfolio for a 10-year time horizon, but her actual exit plan was closer to 3 years. And sometimes, when you're building a 10-year time horizon, or you're building a portfolio based on a 10-year time horizon, that might have been the most accurate information available. But as we know, sometimes these things change. That's a very different portfolio between a 10-year time horizon and a 3-year time horizon. And again, it's not a mistake by the wealth manager. It's a tremendous gap in communication.
And look, she didn't lose anything catastrophic, right? She had been operating for several years with the team that was each doing their individual job well without having the full picture. But when we built that architecture, those gaps closed. And she went into her exit process with a team that was actually functioning as a team, and she ended up getting an optimized exit multiple in doing that. So I want to walk you through something practical right now, right? We talked about these two scenarios. We want to kind of go through something that you can do right now on your own, whether you're watching this live or watching this, the recorded version of this, but it is an advisory team audit. So simple 5 questions, answer yes or no, write them down, whatever you feel is easier. But here are the 5 questions. The first one, in the last 12 months, have any 2 of your advisors spoken to each other directly without you in the room or on a call? Yes or no? 2, does your wealth manager, if you have one, know your current entity structure? Okay. Question 3, does your CPA know your current exit timeline? Do you have an exit timeline? You should. If you don't, get one. Talk to the CPA, put it together. Question 4, has your estate plan been reviewed since your EBITDA crossed 2 million? Do you have an estate plan? Start with that one. Question 5, is there one person on your advisory team who is responsible for making sure the others are coordinated? Okay, so here's what those 5 questions ought to reveal. If you answer no to 3 or more of them, you're operating as that collector profile that we described. You have advisors, but you do not have a team. And this is not a criticism. Like it is just a description of the default position that most business owners are in. And most business owners at your level are in the same position.
The advisory team audit is not designed to identify bad advisors. It's quite the contrary. In our experience, the advisors are rarely the problem. The audit is designed, however, to identify the absence of the architecture that would make those advisors function as a coercive team or coordinated team. The absence is fixable, and it doesn't require replacing anyone, but it does require building the system to function as a single unit.
So let me kind of bring this all together as we wrap this up today. So we started today with a myth. And that myth is that if your advisors are good enough, your financial life is covered. And that myth is comfortable because it means you've already done everything you need to do. Hire smart people, let them work, done. Check, job's over. The challenge is reality is different. Advisor quality, advisor architecture are not the same thing. You can have the best individual advisors in the world and still be operating in the junk drawer instead of having a financial plan with clarity. The quality of the pieces does not determine the quality of the system. The system determines that.
Boy, that is a true statement. The gap that we're talking about has a cost. Because it's easy to hear what Mike and I have described here today and think, well, you know what, guys, this is interesting, but I'm going to deal with that later. You have to understand what later actually means. Every month that passes without a coordinated advisory architecture is another month where your CPA is making recommendations without seeing your investment strategy, where your estate plan is aging out of alignment with your business, and where your exit timeline is invisible to the people who need to be planning around that exit timeline. These gaps don't pause because just because you're too busy to deal with it. They continue to compound over time.
So here's what I want you to understand. Doing nothing is a choice. I think we've said this multiple times in the multiple webinars that we've done. However, it's a choice with a cost, and it's not a theoretical cost. It's a real one. And so the question is not whether you can afford to build a coordinated team. The question is what you are currently paying invisibly because you have not built a coordinated team. So if you want help figuring what that looks like for your specific situation, this is what we do. And that is the next section we're about to jump into, right? So at the start, we talked about, the deal. We want to teach you something useful, and we hope that we have, especially with those 5 questions. And really, I turned it into 10, honestly, John. I mean, I added questions to that. I couldn't help myself.
I noticed that.
Like, this is 5 questions, but then what about this question? And I could go on for days on these, right? We could have a whole webinar on each one of those questions. But I hope that turned a light bulb on. It elicited some response in the sense that you being more proactive is the direction we want you to go in. And so we want to offer, to help that process, this complementary value gap assessment, so that you can start on a kind of an unbiased sounding board, get an idea of what this really looks like in practice, and have some real next steps to get clarity that really matters.
And before Mike walks you through the call, I want to clarify something. And we said this on previous webinars, and we'll continue to say this on future webinars as well. Mike and I are not business valuators. We are not certified exit planners, and we are not M&A advisors. If you come to us during this particular call expecting a formal valuation or from that conversation, or a detailed exit analysis, that is not what the conversation is all about. That's a conversation for another day. What we are is the coordination layer. We're the wealth advisors who specialize in building the collaborative wealth architecture for business owners and their trusted advisors at the stage that you are currently in. So if you have a CPA, attorney, insurance agent, et cetera, that are willing to work together as part of your team, that's fantastic. That's optimal. If not, or perhaps maybe you need an attorney who is an expert in building a deferred sales trust, for example, or a tax person who understands cost segregation, installment sales, and earnouts. And quite frankly, most CPAs who focus on tax prep and file do not understand, or at least focus on those things with any meaningful detail. Our network includes the CPAs, the attorneys, the M&A advisors, and all the other business consultants who handle those specific disciplines that your advisors currently may not. And our job is to understand your situation well enough to connect you with the right people in that network to fill those gaps that you currently have. That's what the value gap assessment is designed to do.
So what is it? Well, it's a working conversation, right? We're going to spend time getting to know your situation. We're going to ask you questions, right? Your business, who's on your advisory team, your exit timeline, your goals, and we can quickly identify where the gaps are at. We've done this long enough and for enough clients that we understand where that is. And without sounding cliche, we're going to listen more than we talk. We're just going to ask you questions. And by the end of that conversation, you'll know 2 things. You'll know where the coordination gaps in your current advisory team are, and you'll know where which strategic partners that we can make introductions to are right fit for you, right? And so you'll leave the call with clear next steps. And most oftentimes we have the calendar links for those professionals that it's not going to be, a dog chasing a cat or a cat chasing a mouse. We're literally going to schedule, because scheduling time when we're together is the accountability side. So when you schedule this call, understand that we are dead serious about getting next steps, because we have relationships with these partners to get you on the calendar with them right now. So life doesn't get in the way and we go back to, we'll do it tomorrow. So specific person, process that matches your situation. That is it. That's the call.
And I'll add this to what Mike just said. The value of that call is not just in what we tell you. Of course, there's value there, but it's in the network that you now have access to. We have spent years building a curated group of professionals who are committed to the same type of coordinated approach that we've described here today and through our other webinars in the series. CPAs who communicate, attorneys who coordinate, and business consultants who understand the exit timeline. The call is the doorway to that network.
So first off, I don't know if you noticed this, John, but I've kind of gone all over the place with the slide deck. And at one point in time, it disappeared. So I get excited about these conversations because I know business owners really need them. And I know that it's not, I had a client yesterday, John, talk to me about, she has an advisor, she talked to a second advisor to get a second opinion. And the second advisor basically told her that it's malfeasance for what the first advisor is doing, and that it's just, they're not a fiduciary and all these bad things.
Oh dear.
Yeah. And I told the client, I'm like, no, it's none of those. The advisor is doing what they feel is best for her and her family. It's not malfeasance. It's not, lack of fiduciary. It's just maybe how they were trained. It's what they feel comfortable with. And those are all good things. They're doing the best of their ability.
Mm-hmm.
And so I got wrapped up into the conversation. That's why I kind of messed up the pitch deck. So I hope everybody will kind of give me some leeway with that. But the point is if today is useful for you, it's super simple. This is the third time I've said it. Schedule time. Scan the QR code you see on the screen. Go to the link below it. It goes to our calendar link. John and I will be there, and we'll go through this value gap assessment. There is no risk for you, no obligation, no cost for you to do this. So please take a proactive stance. This is your business. This is your retirement. These are your clients. If you're a professional that's working with clients, we can help you as a professional bring that value to your clients as business owners. Either way, schedule time.
And before we close today, just a quick preview of what is next in the Value Gap series. Webinar 7 is coming up in 2 weeks. It's called The Golden Handcuffs Strategy: How to Retain Key Talent to Protect Business Value. If you have key employees whose departure would materially affect your business valuation or your ability to exit on your terms, that session was built for you. And by the way, if you missed any of the previous webinars in the series, you can find them on our YouTube channel at Avior Wealth Management.
This one's interesting. They're all interesting to me. That's why we do them. Because we're going to be covering stock plans, long-term incentive structures, how to design retention programs that align with your team's interests or your client's interests, the exit timeline. So that'll be up either later this afternoon or first thing tomorrow morning. I forgot to submit that to compliance, so I did that this morning. So I'll get that up as soon as possible. I will tell you, and I don't know if it's going to be in the webinar, one of the number one reasons why business owners cannot sell their business is because they're too owner-centric. So when we talk about this being one of the key things in terms of valuation and selling your business, I'm telling you, owner-centric businesses don't sell. You need to have these key employees. There needs to be systems in place. So thank you for being here. Appreciate it. If you have any questions, reach out to us. You can reach out to us directly on LinkedIn. If you're watching this on YouTube, drop a comment below. We will get to your questions. We will answer them, and we're happy to help in any way that we can.
Yeah, thank you, everybody. We look forward to continuing the conversation.